Hey everyone, Andrew here from Property Association. Today I want to look at credit and I want to look at the role that credit's played in the property market and what that means for us at the moment and moving forward in terms of a little bit in general the economy, but property in specific. So what is credit? You know, we hear that thrown around, and basically credit in a nutshell is somebody giving you, money or their labor or something in goodwill that you will not pay it back in one sort of go, but that you will slowly over time pay it back. Thus credit cards and so on and so forth. So what happens is when you get approved for credit, it doesn't mean you use it, and that credit doesn't actually transform until you execute your property transaction, your card transaction, or your retail transaction. So you've got a credit card, you're approved for a $20,000 limit, and you can go spend that as you please, and that's when it kicks in. So, but when it kicks in, that's when it becomes debt. And we've just done this little animation to show you that relationship of how that credit turns into debt. So have a look and I'll be back in a sec.
When property market meets credit, they get along like a house on fire. Credit does and says all the right things and sweeps the property market off its feet. Credit cannot wait to be with property market, so they get married. After the wedding, credit turns into debt. The household work starts to pile up, crying kids come along, and all of a sudden, it's a very different picture to what was first envisioned. Debt becomes a constant demand and restraint, unlike the optimistic credit. Like any relationship, for it to work, you need to find the balance, where debt is not overbearing, but instead is managed to help you achieve what is needed.
So what we were trying to show there is to say that all of, when we get approved for a car loan or a home loan or a credit card, we get excited. It's all great. Look at me, I've got access to this much money, but once you use that, it becomes debt. And then once it becomes debt, it's real, and it's there for a long time. So it's one thing that we've seen with our property market, that we were pumped full of credit. And that sort of led to where the pricing had got to a point where it was just definitely too high. Part of the issue is, what are the banks giving us? What were the banks giving us? You and me, we go and work and we exchange our labor for money. So we'll exchange 5 hours of our labor, $30 an hour, and we'll get $150. When you go to the bank, it used to be that we would take that money, put it in the bank would have it there, and somebody else would come and say, well, I need some money. The bank would assess that person and then give that person out the money as a loan, and they would pay back some interest and so on and so forth, and they would pay the bank a higher rate than what the bank paid you as a depositor, and that's how they made their money. But at some point in time, the banking system changed, credit changed, and the authorities allowed the banks to basically create money. And what I mean by that is that money they weren't physically holding from depositors, they were actually just allowed to say, yep, for X amount of money that we hold, we can now lend so much more. So they literally created money out of thin air. And one thing I've been saying for a long time is that interest rates were going to fall. And not just recently, I'm talking about 3, 4, 5 years ago, because I kept thinking to myself, how can you charge someone 6, 7, 8, 9% on something that you've created out of thin air? Now, I hope you sort of understand what I'm saying is that the banks, the money they're lending, the money, because money is, like I said, it's a trade-off for our labor. It doesn't exist. It just does not exist. If everybody went today to the bank and said, I want to withdraw my money, the bank doesn't have it. It doesn't exist. And then the money the bank has actually physically thrown out there as credit for people to purchase these properties doesn't exist. So fundamentally, economically, we're not setting and standing on steady grounds. So let's have a look at what that means, and let's have a look at where it all expanded. So you can see that from 2000 onwards, really, you can see that the investment mortgages have increased at a huge rate. Now, this is where all this credit creation came into place. You can see the gap. You can see that, owner-occupied mortgages increased as well, and corporate credit very little. But overall, investor mortgages went through the roof. So it's at a point where it was just not sustainable. And that credit, now that's sort of been generated out of nothing, and all that serviceability of that money, it's not just Australia, but the world is looking at Australia and saying, okay, can you service this? Can you finance this? So all this credit being created, let's have a look at what it means in terms of arrears. So how many people are actually struggling with payments? Because that's going to dictate just how hard this property hit is going to be. So you can see that for Suncorp mortgages, the defaults have increased from 34 million to 38 million in a year. So that's over a 10% increase in that short time. Now, if you have also a look at the CBA home loans that are more than 90 days in arrears, you can see from 2016 onwards, again, a huge increase there. There's about a 15% increase. So you can see that people are more and more falling into what we call mortgage stress. And mortgage stress is where you are struggling to pay back your loan to the bank. And there's a combination of stuff that happened. We all know that when they were lending money, so much of those loans were what they call interest only, where you just pay the interest. And everybody just thought the property wave would just keep riding up and they'd build equity and be able to do stuff. And eventually the bank said, no, we need you now to pay down the principal. You have to pay back this money. You can't just sit on it forever. And it's really starting to hurt people's ability in general to spend in other areas, because they've got to put more money aside for their loans. Now let's have another quick look at, in general, the 90 days plus across the board, not just CBA. So you can see in general that the home loans have had a really steady increase, but also your credit cards have had an increase and your personal loans have had an increase. So your personal loans are the worst in the sense that what I mean by that is that when you have your home, at least it's your home, it's somewhere for you to live. If you buy it as an investment property, you will have income coming in. But personal loans, which are for holidays or cars, for non-income generating assets, it's really bad. Sorry guys, if you can hear there's a blower going on in the background, so my apologies if it's coming through too loud. But I also want to have a look at Australia in general. So looking at Australia in general in regards to arrears, you can see that the Northern Territory and Western Australia have the highest percentage there, and it's no surprise to see that that's reflected in their property prices. See, normally what happens is that as investors start flooding the market, that's what drives the prices up, because there's more and more demand for property, and that demand pushes the prices up. Now you can see in Northern Territory and in Western Australia, they've had huge corrections because that demand's not there anymore. And if the people that own those properties start to suffer what they call mortgage stress and fall into arrears, then they have to let go of those properties. We've also started to hear about people having negative equity, where the loan on the property is worth more than the property itself. So really all of this has to come under control before we can even think about the market doing anything amazing. There's a lot of optimism at the moment with the market. The Liberal government got in, thank God, because the ALP's policies on real estate would have just been the final nail in the coffin. But it's actually just business as usual, which is quite negative. It doesn't really mean that anything amazing is going to happen. We will see a little bounce back now, because with every dip, there is a point in time where there is a group of people that think, yep, we've hit the bottom, I'm jumping in. They jump in, market jumps up a little bit, but then it corrects itself again until it gets to that right balance, which I don't think we're there yet. But you can see when this all kicked in. So if you have a look, you can see this graph here shows that the investment loans, which is the yellow line, from about 2015 really dropped sharply. So it was at that point where you could start to see the orange become a bigger portion, which is the owner-occupier market, and basically it reached a level where the blue, which is investments, needed to stabilise. It got to a point where they had lent enough money for investment, and they needed to sort of bring that back down. You can see that sharp drop. If you look at this other graph, what you'll see is that literally that yellow line again is your investment housing, and it actually follows the exact pattern almost of the Sydney market, where in 2015 there was a peak, there was then a correction there for a little bit, it then rose again up until 2017, and then bang, it's been coming down since. So really interesting graph to look at, but also have a look at the purple line, which is other personal loans. So people have realized that their debt is an issue, and so as a consequence you can see other random debts, basically it's actually in the negatives. It's really dropped off. So what that means is that people now are not spending, and that's a huge issue. So you look at car transactions, I think that they're near record lows. Yeah, people are really under pressure servicing these big credit lines that they've taken, these big loans that they're trying to service, and they're actually now starting to cut back from a lot of other areas. And this is where the economy in general is really going to slow down, and the government's really going to struggle to do anything to impact that, because normally you can use certain tricks as a government to help, but really our interest rates are so low that they will cut them again. They have to cut them again, because it is really slowing down, but there's not much more they can do. So as I said, it's really got to get back down to the situation where we've got to get back to some sort of balance before the banks can start easing up and putting more credit into the system, because they just simply put too much credit at once. Too many people at one time were approved to say, yep, you're good, you can pay us back over the long run, and there was too much of that, and now as a consequence it's the reverse. And that's the same as any cycle. When you have a boom cycle, it always goes over where it should, and then when you have a declining market, it will go lower than what it should. So when this market bottoms out, and I don't believe it's there yet, but when it does, it will bottom out, 3, 4, 5% lower than what it should. But that's just because market sentiment kicks in. I also want you to have a look at when the non-banks started to kick in. So what we've also seen as part of this relationship between credit and property is that a lot of the major banks who went crazy with credit have had to pull back, and it's opened the door for non-bank lenders. So you can see that those non-bank lenders had really gained some market share up until 2015, where the market is, again got a bit shaky. You can see that their share dropped, which you can call me a conspiracy theorist, but I reckon the majors had seen the non-banks sort of come in. They've gone for a last grab, pumped a lot of cash into the system, approved a lot more people. But then you can see in 2017, it's no longer sustainable. They just can't do it, and those non-banks have come back up in market share because they haven't taken the risks of the majors, and they can afford to give credit out to people. So that relationship between credit and property has left us in a position now where in general we just can't spend. We can't spend on other areas, we can't spend on luxury items. We don't have that disposable income because we need to start paying down some of this credit. So whilst it was all rosy and beautiful, it's really put the squeezes on, and what it's going to do is really put the brakes on the economy as a whole. And then as a consequence, that flow, if you think of it as I use the scenario of a big boulder, and once you get a big boulder, which is then I call momentum, that momentum, when you're marketing, selling, whatever you're doing, you don't want to start putting speed humps in front of it, because you take so much energy to get that boulder moving. But what's happened is the boulder, which was credit, ramped up, and it just became this monster, nothing in its way. It was just smashing through everything and just kept going. And then literally what's happened, 2017, bang, this metal wall's been built up and it's crashed into it, and the line was drawn to say credit's going no further. Guys, we've just had I've just had the stand crash on me, but that was the gist of it. Any questions, let me know. Please like, subscribe. It's really important for us to be able to build more and more of this type of topical discussions. If there's anything else you want to hear, let me know. We will be doing something on Melbourne, which somebody asked us.